Welcome to Investors Insights. Our topic today is Fed dilemma. You heard me right. We've got some important information for you today, and I've just had a great meeting with my distinguished colleagues, Trey Booth and Bobby Norman. Great debate, gentlemen. Appreciate all the research that you've been doing. Let's start off. Bobby, I'm going to ask you to start off because here we are in 2024. We've gotten through COVID. But there's some interesting data you brought in our discussion today about where we are in relation to coming out of COVID. So start there, and then we're going to elaborate on how that ties into the Fed dilemma.
Yeah, as always, we're analyzing the good and the bad of the current market and economic conditions. And one potential concern we have is that the excess savings from the pandemic have been almost fully erased. And so looking at this first chart that shows the excess savings built up during the pandemic era is officially gone. All else equal, this should be considered as a negative for consumer sectors overall, as what could have been considered a stimulus during the pandemic is no longer available. And so looking at the peak seen in the chart in August of 2021, where savings hit $2.1 trillion, it's obviously a concern seeing this chart to see that those savings have disappeared. Perhaps it's not surprising that there are now rumblings of consumers tapping the home equity. Obviously, home prices have gone up post-pandemic as a potential next big stimulus. Obviously, while it certainly would be in the short term helpful, only greater problems will probably be created longer term, encouraging such behavior. So obviously, we're watching consumer spending carefully here, as the consumer has been a key driver of economic and stock market growth. The positive that we're still seeing, which will continue to help consumer spending, is that the job market continues to remain strong. You can see in this chart that jobless claims have ticked up recently, but we're still seeing things at comfortable levels. And also, we're watching jobless claims closely for any concerning trends. It has also been our view that jobs are holding the consumer up. As long as consumers have a job, they will be willing to spend. So it's jobs that are keeping everything together. And we're not seeing a lot of corporate layoffs, which is obviously a positive, but worth watching closely here.
No, I thought your data was outstanding and the way you brought it together, because we've had clients asking us about how long will the stimulus money continue to support the economy. So and you're right, jobs. It definitely matters. And with that, we know the Fed is closely looking at this data, Trey. And also, they've got other data that they're having to deal with. So talk about that in relation to the Fed, what Bobby was sharing and the dilemma the Fed has right now.
Absolutely. Thanks, Greg. So, yeah, the Fed has a dual mandate given to them by Congress to run the economy at full employment and to keep a strong and stable dollar. And so the dollar strength and stability is measured by inflation, and full employment is measured by the unemployment rate, and then the monthly jobs numbers, and then a lot of data that Bobby was just going over. And so the jobs numbers have been very strong of late to match a higher inflation rate. And so the Fed could still fight inflation by keeping its rates high. The chart that I'm showing you here, the orange line is the monthly new jobs created. You can see back over the last few months, we've been near or above 300,000 jobs being created each month. That was at a time where inflation was rising. You can see going back a year ago, the jobs picture was weakening, but inflation was weakening. And so that's a comfort zone for the Fed, because both mandates are working together, not in conflict. The jobs data comes out the first Friday of every month, and then the inflation data typically comes out a week or so later. And so we're in that in-between zone. We'll get inflation print this week. And the downside is that inflation is expected to remain high. And you can see on the far right of this chart that the jobs numbers went from 315 down to 175,000. Now, that's still new jobs, which is stimulative, but that's a large drop.
It's a big
what's
drop.
Concerning is this may be the first time in a year where we see a drop in jobs without a matched drop in inflation. And that puts the Fed in conflict, because the Fed is, at some point, if this continues, now 1 month data period is not a trend, but it could be a beginning of a trend that would put the Fed in conflict of, do we cut rates to ease the economy to help the falling jobs, or do we hike rates to fight inflation, which would make jobs the jobs picture weaker? And so that puts them in conflict, in a dilemma. Which mandate do they take precedent? Historically, they've put jobs in precedent, but we haven't had inflation problems since the 70s. So when those two are in conflict, what is the Fed going to look at most closely? And we'll get a sense of that at their June meeting if the data comes out as expected. So something we're watching very closely, where the Fed may be dealing with a dilemma for the first time this cycle.
Yeah, and we hope as viewers you appreciate the information that you just received, and you can be watching it, for June as to what the Fed does. But that also gives you indications of how much in advance we are looking at data to keep up with things, to know how to navigate the portfolios in relation to the financial blueprints. Also, this topic is not going to fade away as the Fed dilemma, and we're going to continue discussing it on our social media, on LinkedIn, on Twitter, Facebook, our podcast, YouTube, just so you know that we're keeping you updated on some things that may not be hitting the news so much. So with that said, we hope you have a great week. We're halfway through May. As Trey said, we're heading into June here shortly, and a lot of things are taking place. Have a great week, and know that every day here at File Plan Partners, we're striving to see to it that our clients have better, richer, fuller lives. Take care.